Hello, welcome. Uh, so while Siddhartha joins, I will just do a sound check. If I'm visible and audible, just type in a Y or VA. If I'm visible and audible, just type in a VA so that I know if everything is in place. Anyone can just type in so that I'll come to know if I'm audible and visible. Thank you. Thank you. So Siddhartha is having some slight technical issues on his end, some firewall issues. Uh, he will be joining in a few minutes. Uh, Till then, what I'll do is I think we have a good amount of people on the floor. So before Siddhartha enters, I'll just introduce myself. And hello Arvind, and hello Bhavik, hello Santosh. Uh, so as I was saying, I will just introduce myself and introduce Excluto, right? So that we could save some time while Siddhartha joins. I hope that's okay. If that's okay, you can type in okay in the comment section. Uh, so this is our first live webinar, Exluto's live webinar, the next frontier investing beyond the stock markets. We'll enter into the details as Siddhartha joins. To quickly tell you all about ourselves, about me and what Excluto is. Excluto is a wealth tech platform that we are building, and what Excluto helps you to do is it provides you direct access and exclusive access to private asset classes, unlisted access to unlisted space, right? Anything which is not in the listed space, not on the exchanges, right? So it could be VC funds, angel funds, other alternative investment funds, right? So we give you access to that at no cost to the investors. So I mean, the Wealthtech platform act as a discovery tool for the investors where they can explore lots and lots of investment option opportunities, right? And they can go through the details of these funds, details like the sector in the fund is investing in, the investment thesis, a bit about the fund manager, and if an investor is willing enough to engage further with any such fund, they can show interest. They can show interest in that particular fund, and the fund manager will contact. So this is what we are building at Excluto. Currently, we have partnered with around 10 plus funds. We have them on board on our platform, and they differ from the diverse set of funds that we have, ranging from category 1 to category 3 AIF, and not just the domestic funds. We also have USA domicile funds as well on a platform. So that's what also we are trying to do. We are trying to bring the world closer, and basically help explore cross-border investment opportunities as well, right? We have 60 registered investors on our platform. Some of you might have registered on our platform, are there a part of our community already. We have got commitment of around 52 cr, right? Since And it's in the process of getting transacted. And yeah, that's pretty much about Excluto. uh, uh, give you a brief about Siddhartha as well. Siddhartha is the current principal officer, MD, and COO of Ambit Asset Management, and I mean, he's been into the financial space for last 22 years. He have 22 years of experience in this space, financial and capital markets, not just capital markets but unlisted space as well. He's not just an investment banker. He's also an avid reader and writer. I've mentioned that part because he writes for magazines. He's a columnist. He writes under the name, as I mentioned, Sage Siddhartha Speaks. So I mean, if you're curious enough, you can just Google him out and see what he has written till now. Motivational speaker and life coach. He has also been he on a regular basis or on frequently he gets invited to to B schools, top 10 B schools like IIM and and ISB to give lectures. So I mean, Siddhartha wears multiple hats, and I think I've just mentioned just a few points, and it's lots more to his career and his experience. So I'll present to you Siddhartha. He has joined. Okay, he joined and he left again. Wait.
Hi Paritosh,
Hi
Namaste.
Siddhartha. Namaste Siddhartha. How are you?
Very well, thank you.
That's great, Siddhartha. So, Siddhartha, I mean, we sort of utilized the time while you were joining. Uh,
Sure.
I I gave a brief intro about myself as well as I gave a brief intro about you as well. Uh,
Thank
I might
you.
have missed some
Thank you.
points though because you have had a elaborate journey in the last 20 22 years. So, uh, but feel free if you want to, introduce yourself as well, Siddhartha. I mean, of course, there are a lot of people who know you already, right? Who know ambit asset management, but still it would be great if you could just for maybe a minute or two describe about yourself, and then we'll straightly jump into the uh, webinar.
Sure, Paritosh. So, thank you very much, everyone. Paritosh has been very, very kind with the words. I call myself a teacher and a learner who's learning from multiple teachers at all points in time, and at the same time, whatever I'm learning, I'm giving it back to the society and bright young minds who can benefit out of my experience. I still would not call it wisdom, but maybe little knowledge which I have gathered from friends like yourself only. So that's what I am, a learner and a teacher, both at the same time. So let's
That's
start the conversation. Let's start the.
sure, definitely. Yes. Just a quick instruction from my end. If there's anyone who wants to ask question, they can post in the comment section. We'll take the questions after Siddhartha has finished. Just take 20 25 minutes of Siddhartha's time to finish whatever we have planned, and then we'll straightly jump into the Q&A section. So till then, everyone can post their questions in the comment section, and maybe after that, I can also bring you to the stage and interact directly with Siddhartha, if that's fine. So yeah, Siddhartha, I'll just quickly also add the presentation over here. So Siddhartha, I mean, you can start. I have a presentation on the screen. So should we start with
Okay,
the accredited investor first, or whatever
sure.
suits you?
So, what we are going to do is we will break this conversation into three, four parts. You can see the presentation, but more importantly, let's figure out what is the utility of the AIFs, what is the utility of investing beyond the known asset classes. So, Paritosh, you can actually remove the slide. Let's have a conversation, and then, as and when required, then we will put the slides in. Generally, there are three things which are a myth. Number one, how does one get rich? Why does one get rich? And from where do you get that insight knowledge which enables you to get rich? Why is being rich, getting rich is so important? We all know that money cannot buy happiness, money cannot buy joy, money cannot buy so many things. But it's better to have lots of money than having none of it. And typically, from the SEBI's perspective, there are four asset classes in which typically you can invest money. You can invest money through cryptos as well. You can invest money through the gambling as well. You can invest. You can participate into the gaming as well. However, legitimately, there are four avenues through which one can invest the hard earned savings, which otherwise would have gone as expenditure. There are only four asset classes: debt, equity, real estate, and commodities. Debt, we all understand that post tax, post inflation is negative. And so is the case with gold in the longer periods of time, because gold only propels when the fear is at the peak. When the fear is down the dogs, when the fear is in pits, the gold also comes down. And when the fear is at its peak, at that point in time, seldom people tend to sell. Seldom people tend to sell. Because of which, when the gold starts to correct, then people realize that the notional gains have been wiped out. The third thing is real estate. Real estate is an interesting opportunity. However, it's localized. And the challenge with real estate is that you cannot see consistent compounding there. You can't see the compounding on a longer tenor or for significantly larger periods of time. You have one run which can make it double, and that's about it. Then you keep holding the real estate for longer periods of time for the next cycle to come, being happy that your past returns have been fantastic. However, the marginal returns from there reduce tremendously. Another challenge is the bid and ask in real estate is quite significant. Illiquidity is another problem. And one of the biggest problems with real estate is one of the biggest problems is, and I'm assuming that you'll buy the real estate at the market price, not at heavily discounted price. Imagine you buy a real estate and then you have to pay the stamp duty and then you have to pay some taxes. You're already down 6-7% from 100 bucks you have bought. The market price is at 100 bucks, you bought it at 100 bucks, you're already down from 106, 107. If you refurbish it, if you put some more money into it, you're down closer to from 115 to 100 bucks. That's the conundrum, that's the challenge with real estate, and nobody blinks that eye because the future of real estate looks good. Then comes the equity part. Now, equity can also be divided into multiple parts, starting from the bootstrapped equity to the venture capital to the pre IPO, IPO, private equity for the scaling up. And then you have obviously have listed equity. Now, listed equity can also be divided into multiple parts: large cap, mid cap, small cap, micro caps. Equity is a good way of multiplying your money because that's the only asset class by and large with reasonable amount of liquidity, with a reasonable amount of growth compounding. You can have post inflation, post tax returns yet being double of inflation. Post tax, post inflation, post expenses returns at least double of inflation. So that's the beauty of equities. Now the question comes in. Listed equity, everybody knows about. There is a lot of tom-tomming about it, and obviously the markets have done extremely well in last 8, 9, 10 months, and especially after the partial demonetization, after the announcement from the Reserve Bank of India of discontinuing of 2000 rupee notes. The markets have done exceedingly well, nothing short of spectacular. Then why to do anything when your listed equities, whether it is in the form of mutual funds, whether it is form of the listed shares through the broking platforms, why should you invest into any other alternate? The reason is fairly simple. The reason why you should invest into the alternates is the structure of the alternates allow oneself to remain resilient from the ups and downs of the market to a large extent, because the neither the event nor your reaction to the event can be taken by you. So What does that mean? So imagine if you are in an AIF and you have invested some money base after doing very good amount of due diligence even into the listed space, which we call it in the pipe format, public investments in the private equity format, whereby you put in money and the fund manager takes the discretion. Now, there the beauty is that when the market is going down, the fund manager has the full liberty to buy and do whatever is right. He can sit on cash as long as the gentleman wants to and pick up the businesses at the right valuations. And even if the market continues to correct further and further and further and further and further, yet there are no redemptions. And if this fall is because of certain extraordinary reasons, nothing to do with the business, and the fund manager is quite confident, the fund manager can continue to hold his position without having any challenges of exiting. That enables the fund manager to stay put through the tough times, and then when the bounce back happens, participate into that. So that's one of the reasons why AIF format of investing is suitable for investors who have reasonable net worth, who have reasonable understanding. I will shift to some basics so that we cover all of it, and then I would request Paritosh maybe to have some questions and then we can cover. So there are there are three kinds of AIFs. Typically, that's what SEBI has allowed. The first AIF is essentially where one invests into the infrastructure funds, angel funds, venture capital funds, social venture funds, predominantly unlisted. Now, if you think about it, if I have to just give you an analogy, we are seeing that the infra spend in the country has gone up to such high degree at such high velocity. It has been unprecedented. Between FY19 and FY23, the infra spend from the government, from the public sector, not the private sector, from the government itself, has doubled. When is the last time we saw this in our 77, 78 years of our history? Never. So the infra spend has been has been gigantic. If you want to participate into this infrastructure creation story, if you want to get benefit out of this growth of this infrastructure, how would you get there? Your obvious answer would be to invest into the infra companies. There are infra companies which are executing all these projects, and you have dime a dozen. You have large cap, you have mid cap, you have small cap. Why shouldn't I invest into these companies and get the benefit of infrastructure? My point is, when you are investing into a holdco or into a sub, which is sub means subsidiary, which is listed, then the challenge is fairly simple. Not all assets, not all investments of that infra company may be doing good or may be doing well. Certain assets may be doing extremely well, certain assets may not be doing so well. And because of this disparity, you may get average returns because you are investing into the company which is executing 10, 15, 20, 30 so many infrastructure projects, and not all infrastructure projects executed by the company may give you the right results. So what's the solution? What if you only invest into the infrastructure SPV which you like? How can you do it? Bingo, you can do it through AIFs, through alternate investment funds. Can you do it through the InvIT? Absolutely. There are AIFs which invest into the INVIT. By the time, then your again question would be, why can't I invest into the INVIT which is listed? The problem is by the time that INVIT comes onto the bourses, already large part of the juice, large part of the spread, large part of the income is already being taken out. It's been affronted. And hence, what you get as a residue is significantly lower. Thus, if you want to participate into the infrastructure of this country, the better proposition is through the AIF route. Longer tenor, longer gestation, but fantastic returns. Fantastic potential, at least I can say. Not too many infrastructure funds have completely wound up, so there isn't too much of history behind them. But the opportunity looks very, very promising, keeping in mind the focus of the government and the keeping in mind the trajectory which India has picked up in the recent times. Similarly, angel funds, venture capital funds, and social venture funds also form part of the AIF 1 category, AIF 2 category. These are essentially private equity funds, funds of funds, debt funds, little longer in tenor, 4 to 7 years typically. And then you come onto the category 3, in which you invest essentially into the pipe structures which we spoke, or into the hedge funds. Now, can you invest and make money on both sides of the market? Your answer would be yes, I can, through the futures and options. I can deal with futures and options personally. The unfavorable part in this is that India is, by the way, the largest at the moment, the largest FNO position in the. So India has the largest FNO position amongst all stock exchanges, amongst all countries across the globe. It has the largest number of investors as well as the largest position in FNO. The challenge is that roughly around one third of the investors in the FNO market are retail investors. And even funny part is that 90% of the investors, 90% of the investors, especially dominated by the retail investors, they end up never making any money in FNO after a longer period of time. Maybe they will make money in one trade, maybe in three trades, maybe in five trades. But when you get sucked into it, there comes a point when you lose significant amount of money. And that's the challenging part. What is the solution? You enter into a hedge fund with the first being the risk management practices which are institutionalized. You enter into a long short fund which has direction, which makes money on both the sides, which has understanding of the fundamentals as well as momentum. Because fundamentals is equally important if you are caught on the wrong side. And then you understand momentum, and then you understand the exposure, and then you take the bets. And that you can do by investing into a hedge fund through AIF. There are quite a few hedge funds who make money on both sides, long side as well as on the short side of the market. Can you do it in any other manner? May not, may not. And hence, AIF interestingly comes into the play. Then comes then comes another question, that isn't the lock-in period in the AIFs generally is a boon or a bane? Surely, liquidity compromise is a challenge, it's a bane. However, it also helps you control your instincts and your behavior. Let me explain to you in a very simplistic manner. Imagine you have a mutual fund and you have an AIF. Both are fantastic instruments meant for different categories of people. If a mutual fund is delivering you 40% returns, and if the AIF in the shorter period of time is delivering you 3 or 4 or 5%, what would be your tendency? Your tendency, if you it would have been open ended, or your tendency would have been that why am I in this? I should exit and move in there. And then when you get into the mutual fund, the fund which has already run up significantly, it will tend to underperform because law of averages can always appear. Anything which moves up faster comes down also equally faster. And we all have recency bias as one of our cognitive biases, and because of which we end up looking at the data which is recent, which is last 1 month, 3 months, 6 months, 1 year, 1.5, 2 years. We forget conveniently what happened 4 years, 5 years, 6 years, 7 years back. And we believe whatever is happening today is going to continue to happen forever, without realizing that markets always go through cycles and there are always ups and downs. What breaks the market, what shakes the market, what corrects the market is always new, but the outcome is always the same. Sometimes steep correction, sometimes time wise correction, sometimes price wise correction. And in such an environment where there you have steep correction, that's where our tendency is that we stay away. However, an AIF fund manager would typically gonna invest more. He's gonna see where the value lies and he's gonna enter. However, from an investor perspective, a lot of people would want to exit of the fear. So that's some of the these are some of the benefits which AIF present. Another interesting point which you should think through is, we talk about India being a $4 trillion economy. Fantastic. The market cap of India, the market cap of Bharat is $4.2 trillion. What is the challenge? The challenge is very simple. The challenge is you have 16.5 lakh companies. Even if I remove a 10,000 or closer to 10, 12,000 one man company, which may be fictitious companies, I may remove even one third of the companies being just investment companies, although they also do a lot of value add, because without what blood is to the body, money is to the economy, and money is to the business. So even if they are investment companies, they are doing value add. But imagine if even if you want to remove them for the time being, you are still talking about 10, 11 lakh companies. Out of that, how many are listed on the bourses? Out of that, how many are listed on the bourses? Barely 6,000 companies, which means large part of the growth, large part of the economy, which is encapsulating this growth, can never form part of your portfolio. But can you do that through the AIF route? The answer is yes. Another challenge, we keep talking about listed businesses. Top 50 companies market cap constitute closer to $2.2 trillion, 2.1 to 2.2. So nearly 50% or 52, 53% of the total market cap of the listed universe in India is only with 50 companies, which essentially means that wherever these companies will move, the market direction would be there. And one gets definitely, one may negate that argument, but one is definitely swayed by this movement of 50 businesses. They set the trend. However, there are equally, if not more large, there are equally larger companies. There are lakhs of good companies which you can never form part of. And by the time they come on the bourses, already they have matured. Their multiplier effect has already gone out. Think about it. How many times have you seen on the stock exchange or on the listed companies when the companies fail to deliver the margins by 0.5 or 0.75%, which means that the net margin decline is by 0.5 or 0.75% as compared to their previous quarter or Y on Y? What do you see? The stock comes down by 8 to 10%, which means you are fighting for every half percent, every 70, 80 basis margin expansion or compression. On the other side, when you go on the unlisted side, and there are a whole lot of businesses where you see secular growth, Y on Y growth of 35, 40, 45, 50 odd percent. Can you participate into those businesses through the listed marketplace? The answer is no. Now, your argument will be obviously the challenges can be galore because the risk associated with unlisted companies is higher. Absolutely. No doubt about it. Absolutely. You have higher quantums of risk. And that's where the risk management, that's where the fund management, that's where the institutionalization of the investment, and that's where the SEBI's role come into the play. And when the team is sound, there is relative amount of certainty, there is relative amount of conviction that some bets may fail in the unlisted space, in the startup space, but there will be certain some of them surely and necessarily which will become multi baggers. Because remember, lot of growing up work, lot of silent work happens in isolation. When a plant is growing slowly and steadily, when one sows the seeds, and that seeds expands and grows, and slowly you see a small leaf coming out of it, and then that small leaf becomes a plant, and so forth. That growth is unnoticed, but the growth is constantly happening. And exactly the same way in the unlisted marketplace, there are whole bunch of businesses which are growing rapidly without making any noise. Can you be party to it? The answer is obviously yes. One interesting thing which always which always confuses me or keeps me thinking is, and I spoke about it in the beginning of our conversation, rich. When you are born, you have practically no control on which family, what economic background, which class of the society, which strata you will, which strata you will take birth. The interesting part is that entire world is divided by the caste, creed, color, religion, demographics, language, ethnicity, so many. But actually, there's only one bifurcation which divides the people: economic prosperity. So, if you are economically well off, irrespective of what rest of the parameters are, nobody will bother you. And irrespective of what every other tick you will have, if you are economically weak, your challenges will only be galore. Then how do you solve it? Very, very simple. There are only three ways of getting rich. Number one, you start your own business. You start your own business. But not everybody has the capital, not everybody has the mindset to start their own business. They don't want to do things constantly, everything by themselves. Maybe it's a great idea, but there are entrepreneurs who have done it and they have made it big. But if you don't have the zeal, then what is the second option? The second option is, if you don't have the capital and if you don't have the willingness to take that lead, then what do? Is fairly simple. You become a co-founder. You get into a business which is going to grow. You don't know, but you become a co-founder. You become the first, second, third, fourth, initial few employees. Even if the business fails, you have very, very valuable experience. And if the business succeeds, then obviously your ESOP's equity will be very, very valuable. And the third way of getting rich is invest into the wisdom of so many other entrepreneurs. And how do you do it? Smaller amounts and put it at multiple places. And that's the same thing you can do through the unlisted space. The idea is that diversify your bets. Because remember, the biggest innovation, the biggest disruption, the biggest invention will not come in the listed space, because listed space is running on a quarterly treadmill. And for them, the idea is constantly only delivering numbers to millions of eyes, which are watching those numbers threadbare, point by point, on a 90-day period. Hence, if you want to really benefit out of the invention, innovation, disruption, then the better way is to diversify. I'm no way saying that your $100 of your portfolio has to be entirely into the unlisted space, but diversify to a certain extent. Diversify to a certain extent, because that will enable you to take the benefit and understand what's happening around the world and how can you make money out of it. So that's it from my side. I would quote from Manu Smriti, and it says like this: Sarvam Paravansham Dukham. Sarvam Paravansham Dukham. Sarvam Matmavansham Sukham. Sarvam Matmavansham Sukham. What does this mean? It simply means anything which is not in your control, which is not under your prowess, which is not being managed or undertaken by you, eventually at some point in time will give you dukkha, will give you unhappiness, will give you displeasure, will give you grief. Anything, on the other hand, which is controlled, managed, जिस पे आपका नियंत्रण है, if you have prowess on that thing, then that will give you sukh, happiness, bliss. And that is the reason you should know what changes are going to happen in the world, and you should be participant into that.
Thank you, Siddhartha. Thank you so much for the wisdom that you've given right now. I think you have painted a really great picture about the whole unlisted and listed space. The point that intrigued me the most was how big the unlisted space could be, which I think most of us are doesn't have the comprehension of that. How big the unlisted space actually is. So we have received a couple of questions though. I'll take one question. The question is asked by Bhavik. So I mean, this makes sense, what Bhavik is asking, because at the end, when we ask, or if anyone wants to diversify into multiple asset classes, the first thing that comes into anyone's mind is how much to invest, where and where, right? So that's what Bhavik is asking. Let's say, what percentage of ideal percentage of the total net worth should one invest in the alternatives?
Okay.
So
Let me
yeah.
let me give you an ideal asset allocation. So, Bhavik, it's a very interesting question. And the more important part here is that the asset allocation of everyone changes because of three parameters. Number one, the life stage you are in. So, if you are single with no liability, with 100% saving, which is typically the age till about 27, 28, then your asset allocation is different. And if your age is where you have got married and you are looking to get into a house, have a family, then your life asset allocation is different. And then you are in the middle age where your children expenses have exponentially enhanced because of their education, because of their requirements, and your salary growth is reasonable. Then you come to the next stage where children have reasonably got settled. You are at the your peak of your career and you're making tons of money and your expenses have actually reduced. And then you have the last leg, which is retirement or post retirement, where your income levels have reduced, your liabilities have broadly been settled, and you want to be conservative relatively. So these are life stages, five life stages. The asset allocation is varied from one to another. However, I'm going to give you a general thumb rule. So the first thumb rule of net worth is number one. If you are a businessman or if you have a salaried employee, doesn't matter. Or if you are a professional, doesn't matter. At least 6 months to 12 months of money, when I say your expenses, monthly expenses, should always be into safe assets, whether it is overnight fund, whether it is debt fund, whether it is short term debt fund, where you don't have credit risk, where you don't have mark to market risk, and very negligible amount of interest rate risk, which can be liquidated in a hurry. That's number one. Number two, if you're middle aged and if you are, you should definitely have a house of your own. One house, not three, not five, not seven, one house of your own. And why this house? Even if you're living in the same city with your parents, that's fine then. But one house which should be yours and debt free. And the reason is one house, anywhere in the country, also it will do. Even if it is in your native, it's fine. The reason is when the tough time comes, when the tough time comes, and tough time comes unannounced, you may get losses in your business, you may lose your job, you may lose your regular income, there may be challenges in your health. All of that will come unannounced. At that point in time, you still will manage your life with bare minimum necessities if you have a house. If you have a house, a debt free, rent free one house is a must. It's a power psychological power factor, which enables you during tough times to bounce back rather quickly. I'm also a cognitive, so I'm sure Paritosh told you that I'm a behavioral finance and cognitive economist. So I understand the psychology of money, I understand the science of mental economics. And that's where this factor is important. So one house. After that, balance another thing, 5% of your net worth into gold. I told you not to put, but still, which kind of gold? Gold which is physical, not virtual, not paper. Why? You would need the gold when, sorry for the language, when chaos will hit the roof, when challenges will hit the roof. That's when you'll need the gold. At least in India, at least in Bharat, we are sure that there cannot be any massive challenge. But what if there is a Gaza like situation which happens? Or if a Ukraine like situation happens 30 years, 40 years down the line? Who knows? Who knows what can happen at any given point in time? Then what will be there will be physical gold which you can barter for your necessity. So 5% in that. After that, balance everything into equities. Now, of the equity allocation, at least 20% should be in the unlisted space. 20% of the equity allocation should be why? You should always have 35, one third into the large cap established businesses, because these businesses obviously will grow very gradually, slowly. They will give you only double. They will only give you double the inflation post tax, post expense, post inflation returns. Which means if your post tax, post inflation, post expenses number is 15, or post expense is 10, and your inflation is 5. So that's the logic, that you should be double of inflation even after post inflation, post tax, post expenses. You understood? So that's what these large caps can do for you. Number 2, you should invest s- next tranche, which is closer to uh, 25%. So 35% into this, 25% into the mid and small cap listed companies which are growing reasonably faster, and the balance so you are already at 25 and 35, which is 60. Balance, I am assuming that depending on what is your 20% to 40% should be on the unlisted. Now, again, you can diversify through the AIF route. You can do certain transactions by yourself where you have high conviction and high understanding. But trust me, I have seen 99% of the people who have direct investments. And if you don't have clout, you will end up losing money. It's better that you go with the institution rather than doing it by yourself until you have clout. Because when times are tough, who would get the exit? Always remember, from the worst case scenario, how would you salvage your principal?
Great. I hope, Bhavik, that answers your question. And we have one another question, Siddhartha. It's more on the technical front, asked by Vikas sir. So the question is: can joint investors like husband and wife or a family HUF invest in AIF? Are there any SEBI legal compliances involved in such kind of investments? So
So, absolutely. So, three investors can jointly invest as long as there are blood relatives. HUF can also invest into the AIFs, absolutely not a problem. So, there is no restriction per se from the SEBI's side on the ownership structure. So up to three investors, and even AIFs, even HUFs, my bad, even HUFs can invest into the AIFs. There is no legal challenge. SEBI has been very, very, I would say, transformative and open-minded, forward-looking regulator, one of the best regulators in the world, and they understand the succession, they understand the succession planning, the safety security aspect of the longer term investment, and hence they have made all the provisions that this thing should be there as far as the investments are concerned. Paritosh, I will also take a minute. Sorry, I know I stole your word, but let me just quickly tell your viewers as well as our friends. I would not call them viewers because they are all friends of ours. And just a perspective on the accredited investor, and why is accredited investor such a good thing. Now, what is an accredited investor? Accredited investor from the SEBI's perspective is a person who understands these complex or relatively risky investments. They are not safe investments. And in AIFs, the risk is higher, the structures can be complicated. And hence, what SEBI says is that you should at least have 25 crores of net worth, at least should have 25 crores of net worth, 5 crores of investable or liquid investment oriented surplus or investments which are liquid. Your net worth of 5 crores should be in rather financial assets which can be liquidated quickly, and 50 lakhs of annual income at least. If you meet these three criteria, you can be an accredited investor. And if you are an accredited investor, the limits in the PMS, the limits in the AIFs for you can be lesser. And that's an added advantage because you can actually look for good, great teams and lots of them with relatively lesser money. And hence, you don't have to bet a larger sum when you are an accredited investor. So that's a huge opportunity which I think SEBI has given. And all investors, and looking at especially two of the fastest growing states, which is Maharashtra and Gujarat, you will find many lakhs, not in thousands,
Yeah.
who can be potentially be these accredited investors and can participate into the AIFs with relatively modest sums. So that's all I wanted to add. Paritosh, over to you.
I also believe, Siddhartha, there is a certification awarded from the SEBI to accredited investors. There's a legal process involved.
That's correct.
I believe so. Okay, great.
That's correct.
We'll that's for someday else. But again, we have talked about AIFs and all its categories, and you talked about the Indian economy, so on and so forth. So I mean, it naturally brings me to uh, a an ecosystem in itself that is sprouting in India, which is the startup ecosystem, as you would say, the Indian startup ecosystem, right?
Correct.
And that's what I actually wanted to again come to as to. So I've recently heard this news. I was reading that Saudi based company Saudi Aramco
Correct.
is looking to open up a Indian VC arm. So they are looking for a team over here in the VC arm. So that sort of makes me think why the world is looking at India, especially the Indian startup ecosystem. Why India is the heaven for the new entrepreneurs and the new generation. What do you think about that, Siddhartha?
So I call it very simply entrepreneurship or business orientation, not business, but entrepreneurship. So I'll tell you a very simple analogy from our Sanatan perspective. Have
Sure.
you heard of the in olden days people used to call sates. So people who were great business people, they were called sates, sate sahab, sate. And
Yeah.
there were other people who used to be who were called mahajans, right? Mahajan sahab. These were two very common words, and people who are old, they would resonate with them. From what is the origin of these two words? The origin is Mahajan, the one who is greatest amongst the Jan, which means amongst all the people. Similarly, the Seth is actually is a convoluted version of Shresht. Shresht means Uttam. Shresht means the best. So in the olden times, The business people were given the responsibility for taking care of the entire society and then for themselves. Exactly the same way equity owners do. Equity owners, first they pay for the business expenses, then they pay for the salaries of their employees, then they pay for the debt owners' interest, then they pay for the preference shares cumulative dividends, and then whatever is the residual comes to them. Exactly the same way a person who's shresht will think first everything towards the society and then coming back to oneself. That's our roots. That's where the business owner thinks. That's what has been propounded in us, or has been our foundation for 3 4 thousand years. When the world was still thinking what is business, we used to do barter system. Our villages used to produce over 700 things, and all villages were self sufficient. They were only exchanging things. What is that? That is a simple concept. That is a simple concept of business. Now, that is coming full circle back now. Today, the world is recognizing that Indian entrepreneurs, Indian startups, Indian ecosystem of businesses is the best amongst everybody else in the world. For any startup, for any business, what do you require? First, you have to, whatever you have innovated, whatever you have done, whatever you have developed, whatever you want to sell, the first thing which intuitively comes to you is demand and longevity of demand, right? Because if you have created a product, if you have created a service, if you want to do any business, you have to be sure that there are buyers for it, and buyers for it for longer periods of time. with indian demographics with Indian demographics, where one third of the population is below 15 years of age, plus above 59 years of age. So the working population is between 15 to 59 years of age. Two-third of the population, one third is lesser than that. And this younger population and this earning population will constantly make sure that the demand for any of your product and service remains resilient forever. Forever is the word. You think about it, in the West, what happens? Whenever there is a product launch, there are early adopters. After the early adoption, then you have growth, then you have maturity, then you have saturation, and then you have decline. That's the typical product life cycle.
Right.
In India, if I have to just talk about paints as a category, the oldest paints company in India was established in 1888, and it is still growing. And still,
Patient.
we are only one fifth of per capita paints consumption as compared to United States of America, and it's over 130 140 years. So this is what is the first thing. Second thing, we are a punya bhumi. Punya means we are blessed. Bharat is blessed. Why Bharat is blessed? The reason why Bharat is blessed is because if you start any business in India, and that only happens in India, and I can bet on it. I have done more and more case studies to prove this fact, and this also resonates with what our seniors, elders used to say 70, 80 years back as well. That is, if you start any business in India, any business, if you have reasonable smartness, reasonable acumen, reasonable honesty, एंड रीजनेबल ग्रैटिट्यूड टुवर्ड्स ऑलमाइटी, ईश्वर के लिए आपके लिए थोड़ी सी धन्यवाद देने की
Shraddha.
श्रद्धा है, then what will happen? You will start on a good note. Your toughest time will come between 6 months to 12 months. Your toughest time in your business will come when you are on your 6th month to 12 month. Once you have crossed your 18, 19 months, your challenges will start reducing, not propelling. Your 18th month will be the peak of challenge. It will only start subsiding. Actually, your 12th month will be the peak, but sometimes between 12 to 18 months is the peak. After that, challenges will start coming down. After 1100 days of your in your business, you will be profitable at the operating level. After 1700 days, which is nearly 5 odd years, you will be having free cash flows. You will have pat in your balance sheet. Your business will start throwing free cash flows. That only happens in India, nowhere else. That's number 3. We are the only country in the world who, if given a choice, can work for 18 hours without cribbing, and if no work, can lie down for 18 hours and still not crib. So the adaptability of Indians and adaptability of Bharati, and that's the reason globally, everywhere, not even a single country where Indians have failed, not even a single country. And
Okay.
today, the interesting part is the country which who ruled us for 250 years is being ruled by a native Indian.
Yeah.
So, and who knows, some of the European countries, so we already are seeing that in Greece and in a lot of other countries, you have second generation, third generation Indians.
Hmm.
Similarly, what you will see in next 25 to 30 years, at least one fourth of the country's head of states will be Indians. So, by and large, our roots, our ecosystem, our ethos, our Sanatan has taught us such values that it's practically impossible to perish. And that is the reason why everybody realizes that hell or heaven, Indians will grow, and more importantly, whatever they will say, they will do. You will not. I'll give you a very simple thing. What is one thing which everyone is chasing globally? Money, right? Dollars, money, whatever you call it. In West or in United States of America or in Europe, you can be insolvent, you can default. No problem. You start your own business second time, third time, fourth time, fifth time. There's no problem. You keep losing money, and people will keep trusting you, and there is no shame. Think about it. Even if the person is wicked minded and kept losing money multiple times, he has no shame. In India, the ethics are so strong that even if you take 100 or 200 or 500 or 1000 rupees of someone, you want to return that money back. And that is the reason when farmers are not able to pay back 5,000 or 10,000 rupees, it's not that they don't have resources, they have land where they have tilled. But just the shame of they not being able to pay back is such a such a bad thing internally, and hence that ethic of not cheating someone, not swindling anyone else's money, makes us even a better destination for someone to invest in us. And Middle East is realizing that. Saudi Arabia has trusted United States for donkeys of years. And every time they realize that they are opportunistic.
Hmm.
Now Saudi Arabia is trying to build relationship with India, with Bharat.
Right.
And think about it. Once an extreme nation, an extremism, where it was perceived that it's an extreme nation, joining hands and developing huge partnerships with a Sanatan, with a Sanatan country. It talks about our ethics, our value system, and what we stand for. And this is just the beginning. When the Russian and Ukraine war started, both the countries looked up to which country?
India.
India. Whenever African countries are in distress, which country they look up to? India. They know that India is a country which will not take benefit of the vulnerability of some situation. That is the reason. Remember, business is a small part of a larger relationship, human to human relationship. And when you have great relationships, business is essential, but it becomes a part of it. And people globally are realizing that with Bharat.
Agreed, agreed. Economy is one of the major driving forces, I think, all over the globe. So when economy is doing good, I think people are relatively calm. But again, thank you, Siddhartha, for your time. Bhavik has although shared his point of view on the challenges that we face within the startup ecosystem, which is the high valuations, and he might have had a bad experience with some of the angel invest networks. But I think that's the case. Every coin has both two
But
sides and
that is the
pros and cons.
reason. That is the reason. If you look at the institutionalization of it, Bhavik,
Hmm.
because if I am not saying that it can't be overvalued here versus there. The idea is, if you see, where is the supply factor more? In the unlisted space. In the listed space, you have limited supply. Hence, valuations can keep going up and up and up, and people are all right to pay those valuations. In the unlisted space, why should you chase? You don't chase. If you are chasing and paying the top buck, then you are having a FOMO feeling. Remember, valuation is an extremely critical thing because gold today you can pay it for 10 grams 72,000 or 71,000. But if I say that you have to pay 1 lakh rupees for the same 10 grams, you'll still end up making money in gold, but not today, after maybe 4 years. And that time value of money is lost. So, what you need to do is fairly simple: leave that deal. If that deal is not coming your way, there will be many, many, many more. Because everything at a right price will work better for you.
So I think that's naturally. I mean, Bhavik has asked, his next question, that which vehicle, which is the best vehicle where the fund manager's intentions are aligned with the investors.
So you think through it.
Is
Anywhere, wherever there is profit share,
hmm,
anywhere where is profit share, where the fixed fee is minuscule or negligible, it does not matter which instrument. Any instrument where, and fortunately, because of SEBI, everything is transparent today. So everybody knows what is the fees. Wherever the fees is negligible, fixed fee, everything is variable. That's the instrument. It can be a PMS, it can be an AIF, it can be a mutual fund, it can be a equity stock advisory, it can be anything. As long as the manufacturer, the investor, and the ecosystem are all on the same page, where if investor wins, then the manufacturer wins, and then the ecosystem wins, that's the way it should be.
Right. No, that's great. That's a great advice, actually. So with that, I think it's time for us to say our goodbyes, Siddhartha. I would like to thank all the participants as well, all our friends who have joined us today, taken out time to listen to Siddhartha, and definitely I'll like to thank you, Siddhartha, for your time. And we hope to, keep this association going on. I think our community is getting bigger and bigger day by day, so people would still like to keep listening to you on more such
Sure.
subjects. Right, you have a lot of wisdom to share, and that's it. Thank you once again, Siddhartha. Thank you for your time. Thank you, everybody.
Thank
Have
you,
a good day.
Paritosh, and wonderful having all of you here. And best wishes to Excludo for spreading the wisdom of unlisted as well as AIF and putting a new perspective to the alternate investment space. Thank you.
Thank you so much. Thank you. Bye bye.